Imagine running a business where a competitor just opens up right next door and, starts giving away their product for free for like 10 weeks straight.
Right. Total nightmare scenario.
Yeah, exactly. I mean, you would panic. You'd assume your revenue was just about to totally tank. Your customers would, abandon you, and your profit margins would just completely evaporate.
Yeah, absolutely. You'd expect a total collapse.
Right. Well, so today we are looking at a company that is facing literally that exact nightmare scenario, like an absolute tidal wave of new competitors who are offering months of free rent to, well, pretty much anyone who walks through their doors.
It is wild what's happening out there right now.
It really is. Yet somehow this company just beat Wall Street's profit expectations. Their residents are just refusing to leave, and they are setting themselves up for this massive operational windfall. So welcome to a special Talk Tickers edition of our deep dive.
Glad to be here for this one.
Yeah. So for this deep dive, our goal is to, really break things down for you, the retail investor. We are going to be data forward, translate all that Wall Street jargon into plain English, and basically take an opinionated stance on the results. And, deliver actionable insights if you're holding or considering the stock.
Which is so needed right now. I mean, especially with this company.
Definitely. We are looking closely at the Q2 2026 earnings call of Mid-America Apartment Communities Incorporated. Ticker symbol MAA, which we'll just call MAA from here on out to keep it simple.
Yeah, please. That's a mouthful.
Okay.
It's a really fascinating transcript to break down because, well, real estate earnings right now are just fundamentally broken if you only look at the surface level metric.
So for sure, it's like looking at a duck on a pond, right?
Right, exactly. Above the water, it's all calm, polished, corporate speak, the headline numbers, but underneath the feet are just paddling furiously against these massive market currents. Like the actual operational reality is so different.
Totally. I mean, if you pull up a standard stock screener for MAA, you're going to see a bunch of numbers that just do not reflect the physical reality of what is happening on the ground.
No, not at all. Especially in places like Charlotte or Austin or Phoenix. I mean, the market is pricing in catastrophe based on that supply glut you just mentioned.
Right. The new buildings everywhere.
Yeah. But when we actually look at the operational levers MAA is pulling, the narrative completely flips. So our focus today is to basically strip away the Wall Street jargon, look at the cold, hard data, and, figure out if this company is actually drowning in new supply or if they're just quietly building a fortress while their competitors bleed out.
I love that, building a fortress. So let's get into the blueprint for today. We're going to hit the headline numbers first, then the story behind those numbers, then we'll look at management guidance, and finally, the bottom line. So let's start with those immediate headline numbers that Wall Street reacted to when the press release dropped.
Let's do it. So MAA reported second quarter core FFO of $2.08 per diluted share.
Okay, $2.08.
Right. And that beat management's own internal Q2 guidance by 2 cents.
Nice. But wait, before we dig into where those 2 cents came from, we really need to address that acronym, FFO.
Yeah.
Because if you are an investor who, usually analyzes tech companies or consumer stocks, you're looking for earnings per share, right? EPS.
Oh, absolutely. You look at Apple or Microsoft, you see the EPS and you know exactly what they made. It's straightforward.
Right. But when we transition into real estate investment trusts, REITs EPS becomes this completely broken metric. It just doesn't work.
It becomes actively misleading, honestly. And the reason for this requires a quick detour into generally accepted accounting principles, or GAAP.
Everyone's favorite topic, accounting rules.
Right. But it's so important here. So under standard GAAP rules, physical assets degrade over time. Like if a logistics company buys a fleet of delivery trucks, those trucks lose value every single year.
Sure, they wear down, they need parts, they eventually end up in a scrapyard. That makes total sense.
Exactly. And the accounting world forces the company to record that loss of value as a depreciation expense on their income statement. It lowers their official net income, which is fair because the trucks are genuinely losing value.
Right. They are a depreciating asset.
But the problem is that GAAP forces real estate companies to do the exact same thing with their apartment buildings.
Which is just, it defies common sense for anyone who has ever owned property, right? A well-maintained apartment complex in a growing city does not end up in a scrapyard after 30 years.
No, of course not. The land it sits on becomes way more valuable, and historically, the building itself appreciates in value as rents go up.
Yeah, you don't scrap a building, you renovate it.
Exactly. But the IRS and GAAP rules, they mandate that commercial residential real estate must be depreciated over 27.5 years. So every single year, this massive, totally artificial, non-cash depreciation expense is just subtracted from MAA's net income.
Wow. So it artificially tanks their official profit on paper.
Completely. It makes it look like the company is barely scraping by or even losing money, when in reality, there are millions of dollars in free cash flow just pouring into their bank accounts every single month.
Ah, I see. So that is why the real estate industry universally adopted FFO.
Right, funds from operations. FFO takes that artificially low net income number and simply adds the depreciation back in. It strips out the accounting fiction.
That makes so much more sense. So when MAA reports $2.08 of core FFO per share, they are effectively stating the true recurring cash profit their apartments generated this quarter.
Exactly. That's the real cash generating power of the business.
Okay, so they hit that $2.08 mark, beating their own expectations by 2 pennies. I was looking at the granular breakdown of this beat, and the math tells a very specific story about how they are operating right now.
Oh, it really does.
Because management noted that 1.5 cents of the beat came from favorable same-store expenses. And for you listening in real estate, same store just refers to the buildings they have owned and stabilized for more than a year. It just filters out the noise of brand new acquisitions.
Right. It's their core portfolio.
Yeah. So they saved 1.5 cents on running their core portfolio. Then another 1 cent of the beat came from outperformance in their non-same-store portfolio, so the new buildings that are still in the lease-up phase.
Yep, the newer assets.
But wait, 1.5 plus 1 equals 2.5 cents.
The math doesn't quite add up to a 2-cent beat, does it?
No, it doesn't. They only beat by 2 cents because same-store revenues actually missed expectations by roughly half a cent. So I have to push back here.
Go for it.
They beat expectations by 2 cents, sure, but their revenues actually missed their own targets. As an investor, how sustainable is it to just cut your way to a profit beat if the revenue engine is sputtering? I mean, that's usually a huge red flag, right?
It is a totally legitimate concern. And frankly, that half-cent revenue miss is the absolute crux of the entire bear argument against MAA right now.
I mean, you can only squeeze so much blood from a stone on the expense side.
Right, exactly. If a company beats profit expectations strictly by slashing their operating costs while their top-line revenue is flat or shrinking, it implies a real lack of pricing power. It implies that the product is losing market share.
Yeah, it makes me question the sustainability of the whole beat.
And that sustainability question is the right one to ask. However, I think we really have to look at the macroeconomic environment they're operating in right now to get the full picture.
Okay, set the scene for us.
Over the last 3 years, the commercial real estate sector has faced just a brutal combination of inflation, skyrocketing property taxes, and a global insurance crisis that has decimated the net operating income of average operators.
Yeah, insurance has been a killer.
Oh, it's destroying margins. So, in a benign, normal environment, sure, leaning entirely on expense cuts is a red flag. But in a high inflation, high supply environment like we have today, expense management is exactly what separates the elite operators from the ones heading toward distress.
Right, because everyone is facing the same revenue headwinds, but not everyone can control their costs.
Precisely. Squeezing higher margins out of flat or slightly declining revenues is a testament to a massive operational moat. It means that when the macro headwinds eventually subside and revenue starts to accelerate again, their cost structure will be so incredibly lean that the profit margins will just expand dramatically.
Okay, I see. So it's about holding down the fort until the weather clears. But to understand why that top-line revenue was slightly suppressed in the first place, we have to kind of step out of the spreadsheet and look at the physical markets MAA operates in.
Right, we have to look at the neighborhoods.
Yeah, which brings us to the story behind the numbers. And the core narrative of this earnings cycle is this crazy collision between a historic, unprecedented supply glut in the Sunbelt and equally massive, sustained renter demand.
It's a fascinating dynamic.
Let's start with the headwind, because
Right.
this is the ghost haunting every multifamily real estate conversation right now.
The
Supply glut.
The Sunbelt supply wave. I mean, it is nearly impossible to overstate how much New apartment inventory is hitting these markets right now.
It's just everywhere you look, right?
Everywhere. Management explicitly called out Phoenix, Charlotte, Raleigh, Savannah, Austin, and Nashville as markets facing extreme supply pressure. We are talking about tens of thousands of new units delivering simultaneously in these concentrated submarkets.
It's like that buffet analogy. It's like an all-you-can-eat buffet opening right next door to your restaurant.
Exactly. And we have to trace this back to the origin point to understand why it's happening right this second. If you go back to 2021 and 2022, the Federal Reserve had interest rates pinned to the floor.
When money was practically free.
Right. The cost of capital was essentially zero. And at the exact same time, we saw this massive demographic shift, the pandemic migration. Hundreds of thousands of people were fleeing high-cost coastal cities in the Northeast and the West Coast, and they were moving to Texas, Florida, the Carolinas, and Arizona.
The Sunbelt boom.
Yep. So developers looked at that demographic data, they looked at the incredibly cheap debt, and they just broke ground on every single patch of dirt they could get permitted.
But commercial real estate operates on a massive time lag, right? You can't just build an apartment overnight.
Exactly. It takes 2 to 3 years to build a 300-unit apartment complex. So the decisions that were made in the zero interest rate environment of 2021, those are manifesting as physical buildings opening their doors today in the middle of 2026.
Oh, so the chickens are coming home to roost all at once.
All at once. And because everyone had the exact same idea at the exact same time, all of these buildings are entering their initial lease-up phase simultaneously. It creates this hyper-competitive, almost desperate environment for the developers.
Because they have construction loans they have to pay back, right? They need revenue immediately.
Exactly. They need to fill those units to satisfy their lenders. Management noted that in Charlotte, some of these brand new lease-up buildings are offering 8 to 10 weeks of completely free rent on certain floor plans just to get bodies in the door.
10 weeks free. That is insane. I mean, if you are MAA and you have a stabilized, let's say, 5-year-old building sitting directly across the street from a brand new complex with a massive banner reading 2 months free, your ability to push your own rental rates higher is just severely capped.
You're completely stuck.
Right. You can't aggressively raise rents on your current residents, and you definitely can't demand top-of-market pricing for new move-ins when the guy next door is literally giving away his product.
Right. It creates a highly localized price war. And that dynamic is exactly what caused MAA's new lease pricing to stumble, which resulted in that slight revenue miss we talked about earlier.
Okay, so the buffet is offering 10 weeks of free food, but MAA's customers are still staying in their seats. Why?
Well, the actual data point that matters here is how the market is digesting that new supply. Real estate analysts track a metric called absorption.
Right, absorption.
Yeah, it measures the net change in occupied units. So if a developer dumps 1,000 new apartments onto the market, but only 500 people sign leases, the absorption is weak, vacancy spikes, and the market collapses.
Makes sense. Supply outstrips demand.
Exactly. But MAA's data showed something astonishing this quarter. Across their markets, absorption was 1.8 times the amount of new delivery.
Wait, really? 1.8 times?
Yes. Think about the math on that. For every 10 brand new apartments being completed and dumped onto the market, 18 apartments are being leased up.
Oh, wow. So the underlying demand is not just matching this historic supply glut, it is literally swallowing it whole and asking for more.
It is incredible. The demographic tailwinds are just completely overpowering the construction boom. The job growth, the corporate relocations, the overall desirability of these Sunbelt cities, it all remains totally intact.
People still want to live there.
Absolutely. Management tracks inbound migration really closely. They look at where their new residents are actually moving from. In the first quarter, 10% of their new move-ins came from outside their regional footprint.
Okay.
In the second quarter, that jumped to 13%. They noted this was the strongest quarterly increase in inbound migration since they began tracking the metric.
That is wild. So the narrative that the Sunbelt migration was just some temporary pandemic fad is completely debunked by this data. People are still packing up U-Hauls and moving to MAA's markets.
They absolutely are.
But, the earnings transcript presented this really interesting paradox to me. If absorption is running at 1.8 times delivery and inbound migration is actually accelerating, why did management repeatedly refer to the, quote, cautious consumer?
Yeah, they brought that up a lot.
They did. They painted a picture of a prospective renter who is really dragging their feet.
Well, the caution is a direct psychological byproduct of the oversupply. I mean, think about it. If you are a prospective renter moving to Austin and you pull up an apartment hunting app, You are just inundated with options.
Right. You have your pick of the litter.
Exactly. You see 5 different brand new buildings within a 2-mile radius, and they're all offering aggressive concessions. You know you have the leverage as the buyer.
Oh, totally. You're not going to rush.
Right. So instead of touring one building and signing a lease that afternoon, you're going to tour 6 buildings. You're going to pit the leasing agents against each other. You're going to take your time to calculate the net effective rent of 2 months free versus, say, a waived security deposit.
I mean, I would do exactly the same thing.
We all would. But this extended shopping period puts a massive drag on new lease velocity and the pricing power for landlords.
I get it. So the demand is there, but the transaction time is stretched way out.
Yeah.
However, that cautious, price-sensitive behavior seems completely isolated to the new customers walking in the front door.
Yes. The new prospects.
Because when we shift our focus to the people who are already living inside MAA's apartments, the behavioral and financial data tells a completely different story.
It's night and day.
The financial health of their existing resident base is staggering. Their average rent-to-income ratio improved to a remarkably healthy 18%.
I mean, that 18% figure is arguably the most important metric in the entire earnings call for assessing risk.
Let's contextualize that for a moment for you listening. The standard financial advice, like the rule of thumb taught by every personal finance expert, is that a household should spend no more than 30% of their gross income on housing.
Right. That's the classic benchmark.
And in many major coastal markets, renters are routinely spending 40% or even 50% of their income on rent, making them incredibly vulnerable to any economic shock.
Oh, absolutely. A missed paycheck, a surprise car repair, a medical bill, any of that can trigger a default when you're stretched that thin.
But MAA's residents are sitting at 18%. That means they have an enormous buffer of disposable income. They are not struggling to make rent at all. They are living very comfortably within their means.
And we see the direct result of that financial cushion in their collections data. Net delinquency, which is the percentage of billed rent that ultimately goes unpaid, is sitting at a microscopic 0.3%.
Wow. So they are collecting 99.7% of the revenue they bill.
Exactly. This completely insulates them from the bad debt write-offs that often just plague lower-tier apartment operators during economic soft patches.
That's a huge defensive moat. But the financial health of the resident drives another critical metric, right? Retention.
Oh, yes. Retention is the secret sauce here.
MAA's turnover rate dropped to a record low of 39.6% this quarter. That is an astonishing number when you remember what is happening right across the street.
With all the free rent offers.
It's exactly. Despite the shiny new buildings offering 8 weeks of free rent, over 60% of MAA's residents are looking at their lease renewal, looking at the hassle of packing boxes, renting a U-Haul, changing their address, and they're deciding to just stay put.
Because they can afford to. That's the key. The 18% rent-to-income ratio means that when MAA sends out a lease renewal with, say, a 5% price increase, the resident absorbs it without severe financial pain.
It's just not worth the weekend of moving for them.
Right. The convenience of staying outweighs the financial incentive to chase a concession down the road. And management capitalized on this stickiness by pushing renewal lease rates up by 5.2% during the quarter.
And this is exactly how they thread the needle. They are taking a hit on the new leases because of the supply glut, but they are offsetting it by successfully raising rents on this highly captive, financially healthy existing resident base.
It's a brilliant balancing act.
It really is. When you blend the slower new leases with the strong 5.2% renewals, their overall blended lease rates actually remain positive, moving up 100 basis points from the first quarter.
So they are grinding out top-line growth in literally the most difficult competitive environment imaginable.
Which brings us right back to the expenses.
Yeah.
This is the third section of our outline, the operational wizardry. Because if top-line growth is temporarily capped by the supply glut, their profitability hinges entirely on their operational mastery, the cost side.
Right, and they delivered a masterclass here.
They really did. MAA held their same store operating expense growth to just 80 basis points year over year.
That is 0.8%.
0.8%. In an economy where headline inflation, labor costs, and materials have been compounding at significantly higher rates, keeping property operating costs effectively flat requires a highly sophisticated operational strategy.
It's not magic, it's structure. We really need to unpack the mechanics of how they actually achieved a 0.8% expense growth rate.
Please do, because it sounds impossible.
Well, management detailed specific structural advantages they have over smaller operators. The first major driver is their staffing model. They are operating their properties fully staffed with in-house maintenance technicians.
Okay, how does that save so much money?
The in-house maintenance model is a massive cost advantage that just compounds over time. Think about it. When a resident does move out, the apartment has to be turned.
Right. Get it ready for the next person.
Exactly. It needs to be painted. The carpets might need replacing. Appliances need servicing. It needs a deep clean. If a property is short-staffed, the property manager has to call third-party contractors, painters, plumbers, cleaners, who charge retail market rates plus a premium for rapid scheduling.
Oh, and those guys are expensive right now.
Extremely. But by retaining a full staff of internal technicians, MAA handles these turns at a fraction of the cost.
And when you combine that in-house capability with the record low turnover rate of 39.6% that we just talked about, you get a compounding margin expansion.
A virtuous cycle.
Right, because not only does it cost them less to turn an apartment, but they're also turning significantly fewer apartments overall. It is a brilliant cycle of cost avoidance.
It is. But, the most impressive operational victory on the expense side wasn't even maintenance, it was insurance.
Oh man, insurance. I feel like property and casualty insurance has been the silent killer of commercial real estate yields over the last few years.
It absolutely has. We have seen premiums double or even triple in markets exposed to climate risks, like hurricanes in Florida or those deep freezes in Texas.
Yet, MAA announced that on their July 1st renewal, they secured a 12% total premium decline.
The 12% drop.
A 12% absolute decline in a market where most operators are budgeting for 15% to 20% increases. I have to ask, how does a company with massive exposure to the Sunbelt, including Florida and the coastal Carolinas, negotiate a 12% drop in their insurance costs?
It all comes down to scale, data, and risk retention. Small operators are entirely at the mercy of the retail insurance market. But a REIT the size of MAA, with billions of dollars in assets, they bypass the retail brokers completely and negotiate directly with massive reinsurance syndicates.
Oh, so they're playing in a different league.
Entirely. They can leverage their historical loss data, which proves their buildings are heavily mitigated against risk. But more importantly, large operators like this can choose to self-insure a much larger portion of the risk by taking on massive deductibles.
Like how massive?
Sometimes in the millions of dollars per incident. Because their balance sheet is so strong, they can easily absorb those localized losses, say a roof blown off in a storm, in exchange for drastically lowering their ongoing everyday premium payments.
Wow. So they just eat the small stuff to save on the big stuff.
Exactly. And this 12% drop translates to a greater than 6% year-over-year cost reduction on their income statement. And incredibly, management noted this is their third consecutive year of securing insurance reductions.
Now, that is just unheard of right now. They are structurally deflating their own cost basis.
They also noted that property taxes, which is the other massive uncontrollable expense for real estate, are projecting lower than expected as the frenzy of pandemic-era property valuations finally cools off and municipalities adjust their assessments downward. Right, so the fortress is completely insulated on the cost side.
But they aren't just playing defense, right? The transcript highlighted several aggressive value-add initiatives where they are actively mining their existing portfolio for new high-margin revenue streams.
Oh, they're playing serious offense, too. The property-wide Wi-Fi initiative is probably the clearest example of this strategy.
Let's talk about that, because I found that fascinating.
Historically, residents contracted directly with local cable companies for internet, right? You move in, you call Comcast, you set it up. The landlord got absolutely nothing out of that transaction.
Just a headache when the installer showed up?
Pretty much. But the new model is bulk Wi-Fi. MAA retrofits an entire apartment community with enterprise-grade internet infrastructure. As residents sign new leases or renew their current ones, they are automatically enrolled in a mandatory technology package.
The economics of this are just brilliant. Because MAA is buying the bandwidth in bulk at wholesale rates, they can provide the resident with gigabit speeds at a price point that is often slightly cheaper than what the resident would pay retail.
Right, so it's a win for the resident. The Wi-Fi is active the exact second they unlock their door on move-in day. No waiting for an installer.
Exactly. But MAA captures the spread between that wholesale cost they pay and the retail charge they bill the resident.
It is essentially a high-margin digital utility business operating right inside their real estate business.
And the revenue growth from this initiative is explosive. They reported that Wi-Fi revenue surged from $500,000 in Q1 to $850,000 in Q2.
That is a 70% sequential jump in a single quarter.
And once the infrastructure is installed, the marginal cost to add a new resident to the network is practically zero, right? Meaning that $850,000 is flowing almost entirely to the bottom line.
Almost 100% margin on the incremental user. It's fantastic.
But the real heavy lifting on the revenue enhancement side comes from physical renovations.
The interior unit upgrade program.
Yeah. They take an older apartment, maybe built in the 2010s, featuring outdated black appliances, cheap carpet, Formica countertops, and they just gut it. They install stainless steel appliances, luxury vinyl plank flooring, quartz countertops, modern lighting.
The full works.
Year to date, they executed this strategy on 3,504 units.
The sheer scale of that renovation program requires immense logistical coordination. I mean, over 3,000 units in half a year. But the numbers absolutely justify the effort.
They really do. Management provided exact figures, which allows us to basically reverse engineer their return metrics. They stated their average capital expenditure per upgraded unit was $5,134.
Okay, so a bit over $5,000.
Right. And I was running the math on this while reading the transcript, and it is a textbook example of efficient capital allocation.
Yeah.
For that $5,134 investment, they're able to charge an 11% premium in rent compared to the unrenovated unit sitting directly next door.
An 11% premium is massive.
It is. And management stated this yields a 25% cash-on-cash return, which significantly crushed their own internal expectation of a 19% return. Let's walk through the mechanics of a 25% cash-on-cash return so listeners understand exactly why this is such a powerful growth engine.
Yeah, let's break that down. Cash-on-cash return is a critical metric for real estate operators.
Yeah.
It basically measures the pre-tax cash flow generated by an investment in a given year divided by the total initial cash outlay.
Right.
So if MAA spends roughly $5,000 on a renovation and achieves a 25% return, they are generating an additional $12,250 in new annualized rent strictly because of those upgrades.
Which means the entire $5,134 investment pays for itself in exactly 4 years. Mm-hmm. After month 48, that extra $1,250 a year is pure, unadulterated profit for the remaining lifespan of those finishes, which could be another 6 to 8 years.
It is an incredibly fast payback period. And, there is a secondary benefit that doesn't immediately show up in the yield calculation, but it is vital for operational efficiency.
Oh, what's that?
Management specifically highlighted that these newly renovated units are leasing up 10 days faster than the non-renovated units.
Wow, 10 days.
Yeah. In multifamily real estate, vacancy is the ultimate enemy. A vacant unit is an asset producing a negative yield. By cutting the downtime by 10 days per turnover, they are recapturing hundreds of dollars of lost revenue per unit, which further boosts the hidden ROI of the whole renovation program.
So they are surgically upgrading their existing portfolio to drive yields. But they are also making macro-level moves regarding buying, selling, and building entire communities.
Yes, their capital allocation strategy.
The capital allocation segment of this earnings call was arguably the most revealing window into management's overall philosophy. They are demonstrating a level of discipline that is just rare in corporate real estate.
Very rare.
Let's look at the 3 levers they are pulling: stock buybacks, property dispositions, and internal development.
Started with the buybacks, they repurchased 383,000 shares of their own stock for $50 million, executed at an average price of roughly $130 per share.
Which is a measured, opportunistic buyback that signals they believe their own stock is trading at a discount to the net asset value of their underlying real estate.
Exactly. But the real masterstroke is how they are managing their physical portfolio. Management detailed the recent sale of an older 30-year-old asset located in Raleigh.
Right. This was a property that likely required significant structural capital expenditures in the near future. Roofs, HVAC systems, paving, all the expensive stuff.
Exactly. And they have 2 more aging properties slated for disposition in the back half of the year, including a 42-year-old complex in Dallas and their sole remaining property in Washington, D.C.
Which indicates a strategic exit from a regulatory-heavy market, by the way.
Oh, absolutely. Rent control and regulations make D.C. tough.
So they are pruning the dead wood from the portfolio. But what makes this fascinating is the pricing arbitrage. Management explicitly stated they are selling these 30 and 40-year-old assets at capitalization rates in the 6% to mid-6% range.
Right.
But at the exact same time, they are categorically refusing to buy new, stabilized properties on the open market because the asking prices represent a 4.5% cap rate.
This is where it gets really good.
For you listening who isn't living and breathing commercial real estate every day, we need to thoroughly explain cap rates and why accepting a 4.5% yield right now is a terrible idea, while selling at 6% to build at 6.5% is a brilliant move.
Yeah, let's demystify the cap rate. Capitalization rate, or cap rate, is the fundamental gauge of yield in real estate. You calculate it by taking the net operating income of a property and dividing it by the purchase price.
So it's basically the return on investment if you bought it in all cash.
Exactly. If a property generates $1 million in net income and you buy it for $20 million, you are buying it at a 5% cap rate. The easiest way to conceptualize it is to compare it to a bond yield. It is the unlevered return you get on your cash.
And right now, the risk-free rate of return, like what you can get by simply lending your money to the U.S. government by buying a treasury bill, is hovering around 4% to 4.5%.
Precisely. If you can get over 4% completely risk-free with zero operational headaches, why would you ever buy an apartment building that only yields 4.5%?
You wouldn't. Real estate is inherently risky. You have tenants, you have roofs that leak, you have macroeconomic exposure. You require a risk premium above the treasury yield to justify the investment.
Exactly. An acquisition cap rate of 4.5% means the seller is demanding an astronomically high price relative to the income the building produces. It means the market for new buildings is just wildly overpriced.
And MAA's management team sees this dysfunction in the private market. They're looking at sellers demanding 4.5% cap rates and simply walking away. They have the discipline to not grow just for the sake of growth.
Which is hard for a public company to do, honestly. Wall Street loves growth.
They do, but MAA is holding firm. Instead, they are taking the cash generated from selling their 40-year-old high-maintenance headaches in Dallas and Raleigh at 6% cap rates, and they're funneling it into their internal development pipeline.
Because they have their own construction and development arm, they bypass the inflated open market pricing completely. They are actively funding a development pipeline that is growing from $804 million toward a target of $1 billion.
And the most critical data point here is the expected yield on these self-developed properties, which is 6% to 6.5%.
The arbitrage is perfectly executed.
It really is. They dump an aging, capital-intensive property yielding 6%. They refuse to overpay for a market asset yielding 4.5%. They take the capital, build a brand new, state-of-the-art property with zero deferred maintenance, and achieve a 6.5% yield.
It's beautiful.
Yep.
They are systematically upgrading the physical quality of their portfolio, drastically lowering their future capital expenditure requirements, and increasing their overall cash yield, all without having to tap expensive equity markets or take on punitive debt.
But it requires immense patience, right? Because development takes years, whereas an acquisition gives you immediate revenue.
It does take patience, but the long-term value creation of the strategy is just exponential compared to blindly acquiring overpriced assets just to satisfy Wall Street's demand for immediate top-line growth.
Okay, so if we synthesize everything we have discussed so far, MAA is running a fiercely disciplined, operationally optimized organization. They are mitigating the supply glut with high resident retention. They are stripping out expenses like insurance, generating 25% returns on interior upgrades, and playing a brilliant game of capital arbitrage.
They have fundamentally de-risked the present.
Yes, but for a retail investor looking at the ticker symbol today, the stock market is a forward-looking mechanism. The past is already priced in. The value of the stock depends entirely on what happens next.
Right, which brings us to management guidance and their projections for the remainder of the year.
Management guidance is where optimism meets accountability, and MAA provided a very nuanced outlook. The headline takeaway is that they maintained their full-year core FFO midpoint guidance of $8.53 per share.
Which is impressive. Despite the chaotic supply dynamics and the cautious consumer behavior, they are holding the line on their ultimate profitability target for the year.
They did make some subtle adjustments to the components of that guidance, though. They slightly lowered their expectations for full-year same-store revenue growth, explicitly citing the fact that new lease pricing is taking longer to recover due to the competitive pressures we discussed earlier.
But they completely neutralized that revenue headwind by officially raising their expectations for full-year expense savings. Again, they are utilizing their operational control to protect the bottom line, regardless of macro volatility.
However, the most critical piece of guidance, the statement that really forced analysts to recalibrate their models, was their specific projection for the third quarter. Management explicitly stated they expect Q3 blended lease pricing to be superior to Q2.
Yeah, that was the big surprise.
This prediction is a massive structural anomaly in the multifamily industry. Apartment leasing is governed by strict seasonality. The second quarter leading into the summer is the undisputed peak leasing season.
Always has been. Families move when children are out of school, college graduates are relocating for new jobs, and the warmer weather just facilitates moving.
Right. And by the time you enter the third quarter, especially September, demand naturally tapers off and pricing power usually cools down significantly. So for management to forecast that Q3 pricing will accelerate past Q2 is a bold departure from historical norms.
Very bold. They are predicting a trend they have not witnessed in the last 4 years.
So what's driving that? Because it's a courageous forecast, but they aren't making it blindly.
No, they presented granular, forward-looking data to justify their confidence. They monitor forward leasing velocity on a daily basis. They noted that pre-leasing metrics for August were running 70 to 80 basis points ahead of the same period last year.
Okay.
And the trajectory for September was trending even higher.
The top-of-funnel metrics supported as well. They reported that lead volume inquiries from prospective renters was up 10% to 15%, and more importantly, physical visit volume, which tracks the number of people actually walking onto a property to take a tour, was up 10%.
That conversion from digital leads to physical tours is a strong indicator of high-intent demand. They are seeing tangible, accelerating traffic on the ground that underpins their confidence in this late-season surge.
I have to play devil's advocate here, though, because if I am an investor, I see a massive risk in this projection.
Let's hear it.
Management is heavily dependent on an extended late summer leasing surge to validate their guidance. But earlier in the call, they spent significant time detailing how cautious and slow the consumer has become.
Right, the 10 weeks of free rent effect.
Exactly. If renters are delaying decisions and shopping around endlessly for the best concession, isn't banking on a prolonged September surge a massive gamble? Like, what happens if the macroeconomy softens in August, job growth stumbles, and that momentum simply evaporates?
It is the central risk of the thesis, without question. If the broader economy enters a recession in the third quarter, that late summer surge will fail to materialize and MAA will likely miss their guidance.
Yeah, that's what worries me.
However, I believe management's confidence is rooted in a data set that provides immense visibility, which is the macro supply pipeline. They know exactly how many competing units are scheduled to deliver in their submarkets over the next 90 to 120 days.
So they're seeing the end of the tunnel regarding the construction boom.
Precisely. The unprecedented supply wave we have discussed extensively is finally cresting. But more critically, management has total visibility into the back end of the pipeline. They know exactly what is not coming behind this current wave of deliveries.
And what is not coming?
Anything. Apartment developers are completely locked out of the capital markets right now.
Let's explore why that is for a second. A developer doesn't just use their own money to build a $100 million apartment complex.
No, of course not. They need a construction loan from a regional bank, and they need immense amounts of equity capital from institutional investors.
Right. And right now, regional banks are heavily constrained and pulling back from commercial real estate exposure.
Exactly. And simultaneously, institutional equity partners look at the current 7% to 8% interest rates on construction debt. They look at the stagnant rents caused by the current oversupply, and they realize the math on new development simply does not work.
The numbers don't pencil out. A project that penciled out beautifully at a 3% interest rate in 2021 is a guaranteed money loser at an 8% interest rate today.
Exactly. Therefore, the equity capital has vanished. Management highlighted a stunning statistic to quantify this freeze. New multifamily construction starts have been trending below long-term historical averages for 13 consecutive quarters.
13 quarters. That is over 3 years of developers failing to break ground on new projects at a historical replacement rate.
So MAA is looking at the chessboard. They see the immediate intense pressure of the current deliveries beginning to ease as we move through the late summer. But they also see a massive void forming behind it. They know that by the time we roll into 2025 and 2026, the spigot of new supply will be completely shut off. This knowledge gives them the operational courage to hold the line on pricing right now, avoiding the temptation to offer desperate concessions, because they know the renter will have drastically fewer brand new options to leverage against them in the very near future.
They are essentially calling the absolute bottom of the supply cycle.
They are.
And that structural reality leads us directly into our final verdict, the bottom line. We have dissected the mechanics of the earnings beat, the brutal realities of the Sunbelt supply glut, the ferocious underlying demand, the 25% renovation yields, the strategic capital allocation, and the bold data-backed guidance.
We've covered a lot of ground.
We have. So when we aggregate all of these moving parts, what is the definitive takeaway for the retail investor?
Based on a comprehensive analysis of this transcript, this earnings call is an incredibly bullish signal for the long-term patient investor.
Really?
Yes. It is a masterclass in defensive operations setting the stage for offensive growth. A great management team is not defined by how rapidly they grow when capital is free and demand is unconstrained. They are defined by how ruthlessly they protect margins when the macroeconomic winds are entirely against them.
That's a great point.
Right now, MAA is navigating a historic, unavoidable headwind in the form of regional oversupply. They cannot control how many permits were issued in Austin 3 years ago, but they are executing flawlessly on absolutely every variable within their control.
They're controlling the in-house staffing models, negotiating massive insurance reductions, rolling out high-margin digital amenities, and aggressively upgrading physical assets for outsized returns.
Exactly. They are executing a disciplined capital strategy, divesting aging assets at premium valuations and funding their own high-yield developments while refusing to subsidize the overpriced open market.
And crucially, they are doing all of this from a position of immense financial strength. We haven't even touched on the fact that their net debt to EBITDA ratio is sitting at a remarkably conservative 4.5x, and they possess over $880 million in immediate liquidity.
Which means they face zero financial pressure to make desperate operational decisions.
So if you are looking at your portfolio right now and evaluating a position in MAA, the actionable reality is this. You own a rock-solid, elite-managed REIT with a pristine balance sheet. The slight softness in current top-line revenue is a temporary localized weather system, not a structural flaw in the business model.
You are effectively collecting an $8.53 per share core FFO yield to comfortably wait out the final stages of the supply glut.
And the downside risk is heavily mitigated by their expense controls and the financial health of their residents.
The business is fundamentally de-risked. They are simply treading water highly profitably, waiting for the macroeconomic tides to shift back in their favor.
And that impending shift brings us to a final, larger question to consider for you listening, a scenario that builds logically on the data we just explored. We know the current supply is being absorbed at a massive 1.8x rate.
Right.
We know demographics are driving 13% inbound migration. And we know definitively that construction starts have been suppressed for 13 quarters because the capital markets are frozen. Consider the timeline. If it takes 3 years to build an apartment building and nothing is being started today, what does the Sunbelt real estate market look like in late 2026 and 2027?
It looks like a desert for new inventory. All the units currently flooding Charlotte, Phoenix, and Austin will be fully absorbed by this relentless demographic demand, and then the pipeline runs completely dry.
What happens to MAA's pricing power in that environment? You have a captive resident base spending only 18% of their income on rent. You have thousands of new people migrating to the region every month. And suddenly, the competitor across the street offering 2 months of free rent doesn't exist anymore.
There are no new buildings.
Exactly. Could we be staring down the barrel of a massive, unavoidable structural rent spike across the entire Sunbelt in 2027? And if that happens, while MAA is operating with this incredibly lean, optimized expense structure, what will that do to their FFO margins?
It creates the potential for explosive margin expansion. The current muddy waters of the supply glut are temporarily masking what could be one of the most favorable pricing environments in the history of the multifamily sector just a few years down the road.
The market is pricing in the present fear, entirely ignoring the future scarcity. Thank you for joining us on this deep dive into MAA's operational reality. Keep dissecting the mechanics behind the metrics, keep looking past the headline numbers, and we will see you next time.